Hey everyone, and welcome. Today, we are going to break down one of the most popular and honestly most straightforward strategies out there, the moving average crossover. It's a really cool visual way to spot market trends and hopefully ride that momentum. So let's dive right in. The whole idea behind this boils down to one simple phrase. Follow the trend, don't fight it. Seriously, that's it. We're not trying to be heroes and predict the exact top or bottom of the market. Nope. The goal is just to figure out which way the current is flowing and swim with it. And this, right here, is the perfect way to think about it. Just picture it. You could be a surfer, spotting a great wave, turning your board, and getting an awesome ride all the way to the beach. Or you could be in a kayak, trying to paddle against that exact same wave. I mean, which one sounds easier? Which one sounds more fun? That's what we're learning to do today. How to spot that wave and just ride it. Okay, so you've got the mindset down. That's the easy part. But how do we actually apply it? Let's get into the nitty-gritty, the specific tools and the rules you'll need to make this strategy work. It all kicks off with this one big question, right? How do we actually spot the trend? I mean, if you look at a price chart, it's just chaos. It's up, it's down, it's a lot of noise. We need a way to cut through all of that and see what's really happening. Well, our secret weapon here is something called the moving average, or MA for short. It sounds technical, but it's super simple. All it does is take the average price over a certain number of days, say the last 10, and draws it as a nice, smooth line on your chart. Instantly, all that crazy up and down noise gets filtered out, and you're left with a much clearer picture of the underlying trend. But here's the thing. A single line is good for seeing the general direction, but it doesn't give us any signals. To make this crossover strategy actually work, to tell us when to buy or sell, we're going to need a team of two. And here's our dynamic duo. We're going to use a specific type called an exponential moving average, or EMA. All you need to know is it reacts a little faster to recent price changes. So we've got our fast MA, the 10 EMA, which is like a speedboat that stays really close to the price. Then we have our slow MA, the 50 EMA, which is more like a big cruise ship, showing us the bigger, more established trend. The real magic happens when these two cross paths. All right, we've got our tools. Now let's talk about the rules of the game. We're going to lay out the exact system, how to get in, how to protect your capital, and, just as important, when to get out. This is it. This is the heart of the entire strategy. It's called the crossover for a reason. When that fast little speedboat line crosses above the big, slow cruise ship line, that's our signal. It suggests momentum is picking up, and it's time to think about buying. And on the flip side, when the fast line dips below the slow one, that's our heads up that the trend might be turning bearish. It's simple, it's visual, and it's right there on the chart. Okay, now here's a little pro tip for you, something that can really level up your entries. Instead of jumping in the second that crossover happens, just take a breath. A more patient way to play it is to wait for the price to pull back a little bit and touch that fast-moving average. This often gets you a much better price and stops you from chasing a trade that's already taken off.
All right, listen up, because this part is absolutely non-negotiable. No strategy is complete without managing risk. So if you're buying, you're going to set your stop loss just below the last significant dip in price. That's called the swing low. If you're selling, it goes just above the last peak, or swing high. This defines your exact risk on the trade before you even get in, making sure one bad trade doesn't blow up your account.
So you're in a winning trade. Awesome. But when do you get out? Well, you've got two main options. Option one is for trend riders. You can use a trailing stop that kind of just follows that slow-moving average, letting you ride the wave as long as possible. Option two is for the planners. You can look at the chart, find the next major area of resistance, and set that as your take-profit target from the get-go. Theory is one thing, but seeing it in action, that's where it really clicks. So let's do just that. We're going to walk through step-by-step a real trade example using the Cardano, or ADA, 4-hour chart. Okay, here's our setup for this live fire exercise. We're looking at Cardano on the 4-hour time frame. Our tools of choice are the 10 EMA for our fast line and the 50 EMA for our slow line. The stage is set. Let's see how it plays out. And there it is. Step one, we get the signal. You can see it clear as day. The fast 10 EMA has just pushed up and crossed over the slower 50 EMA. This is our flashing light, our alert that a new uptrend could be starting right now. Next up, step two. This is where that patience pays off. Remember the pro tip? We don't buy right away. We wait. We watch for the price to have a little dip.
a small retrace back down to touch our fast 10 EMA line, and that is our trigger to get into the trade.
The moment we're in the trade, the very next thing we do is protect ourselves. Step 3, we look back on the chart, find that last significant low point just before our entry, and we place our stop loss just a little bit below it. Boom, risk is defined, and we can relax a little. And finally, step 4, the exit. We don't get greedy, we don't get scared, we just follow the system. We stay in this Cardano trade, riding the trend up. And our signal to get out? It's just the reverse of our entry signal. When our fast 10 EMA finally crosses back under the slow 50 EMA, the ride is over and we close the trade. Okay, that example really shows how a simple set of rules can work wonders, right? So before we wrap this up, let's go over just a few key tips to help you use this strategy even more effectively and trade a little smarter. Let's run through these real quick. First, and this is a big one, this is a trend following strategy. So it works great in markets that are clearly moving up or down, but it can get you chopped up in sideways, messy markets. Second, this thing is super versatile. You can use this on crypto, stocks, Forex, you name it. Third, for extra confidence, try to look for trades where the crossover signal also happens near a key support or resistance level. And finally, feel free to play around with the numbers. Shorter settings like 5 and 20 might be better for scalping, while longer settings are better for swing trading. When you boil it all down, the real beauty of the moving average crossover is its elegance and power. It helps you catch big moves, often pretty early on, all while tuning out that distracting day-to-day market noise that causes so many bad decisions. So, we've laid out the tools and the rules, and you've even seen it in action. The only question left is, now that you have the framework, what trend are you going to go look for first?